All right, guys. Well, let's bring the conversation back into our camp. Let's talk about mortgage rates. So mortgage rates plunge.
Yay!
I love how they say that. Plunge.
Plunge.
Yeah.
Mortgage rates plunge and demand finally inches back. This is from CNBC. The average contract interest rate for a 30-year fixed rate mortgage with conforming loan balance decreased last week to 7.61 from 7.86.
Call them up.
And applications to refinance increased 2% for the week and were 7% lower than the year prior. But look, there's a little bit of thawing, but I said a Monday Mortgage Minute last week, I'm like, no one's really shouting from the mountaintops, hey, 8 is down to 7.5. Yeah. 7.5 is down to 7.25.
Do it.
Yeah.
So what I have to say about this is honestly, stop focusing on the headlines, because I saw last week many people
say, like we're doing?
Yeah. but what I mean, taking them for what they actually, taking them for truth, because last week I saw so many articles, the Fed's done, no more, rates are going to get dropped. But then we see what data comes out and how the market performs this week. And I'm like, I called it every single time right before they raise. We have a drop and then only to get picked right back up. So they themselves have been saying it. I mean, you saw it in Jerome Powell's conversation this week. They're not confident in what they've done. They've done enough. I mean, they've done some, but not enough.
Yeah. It's just remember, the earlier analogy that I use is when you're in a boat and there's a hole and you plug that hole. And then it's like, oh, dang, now I got to plug that one because another one opened up. And I just think that right now, our Uncle Pow Pow is running out of that, that tape and putting areas.
What's that stuff called? Flex Seal. Remember the Flex Seal commercial?
That's a good one.
He's Flex Sealing the economy.
I sometimes want to go into that infomercial and just buy it because I'm one of those. I'm very vulnerable with that.
So last week, yes, mortgage rates did see I would say, precipitous drop relative to where they came from, but they're only going to return there. It's because the problem is not solved. So let's just quickly, for everyone listening and watching, let's address the mechanics of this. We are not out of the woods yet when it comes to the Fed accomplishing their mandates of returning inflation back to 2%. And restoring monetary price stability. And so until those things happen, they have to continue echoing the things they've been telling us for months and quarters on end, which is rates are going to have to stay higher for longer. Mm-hmm. So we need to all be prepared that rates are going to be higher for longer because they are literally telling us. So if we are to believe them, and this is a case where I'd say we should, because we see that rates are staying higher for longer, they're also saying it. That's 2 for 2. Yeah. It's not a case where they're saying one thing and the other's happening. Yeah. That's another topic. But this is not that case. Yeah. Rates are going to remain here for a while.
Okay. So if you had to take a wild guess right now, Andy, how long do you think these going to, when you're saying rates for longer, what are you talking about? March of next year? June? Like, where are you at?
No, I honestly think we're not going to see any rate change from the Fed until Q3. And if they do, it's going to be due to unspoken political pressure coming right into the election season.
And I asked that just so we could all have an idea, because I want to be like.
And it has nothing to do with the economy. I mean, here's the thing: like, they're going to look at all these numbers. First of all, let's call a spade a spade. Yeah. They've been raising rates since March of 2022, and right now they're still saying, now 20 months later, we are still not yet seeing the effects and the lagging effects after all this time. Yeah. So now after 20 months, you're trying to tell me that in like 3 or 4 or 6 or 7 months that it's going to be the way it's supposed to be? I don't think so.
I know.
It's going to take a long time, and I don't think that we're going to get out of 2024 getting back into the 5s in mortgage rates, because again, that then creates another problem where you have demand resurge. You're going to see prices stay higher or go up again, and that creates a whole different affordability issue even if prices go low. Rates can go low, but prices are going to go high again.
I mean, let's think about that. If rates do go down, let's just say even to the 4s, what's going to happen out there right now?
The market gets flooded.
With no inventory.
With no inventory. Prices stay the same or stay elevated depending on what market you're at. And we go back to the same cycle that we've been in for some time.
You know what's going to happen if rates go to 4? People that bought right now at 7 and 7.25 and 7.5, they're going to refinance.
Of course,
and they're going to save on their monthly payment.
Yeah.
And so here it is. Yeah. This is again, we get this like, oh my gosh, you guys, you'd be stupid to buy a house at this price at this at this rate. Okay, that's fine. But the person who did buy a house at this price is going to be the winner in the end, because let's say they bought a house at $900,000 at 7%. Okay, now if their rate becomes, let's say 4 or 5, they're going to save on their monthly payment and they'll have a house while you're out looking for one, bidding against 20 other people.
And that $900,000 house is going to go to
$1
million.
How's that work out? Because
$1 million plus.
Again, if rates drop again and prices stabilize, it's going to price pressure higher. So that person also isn't going to have some cataclysmic fall in their home value. Yeah, I don't understand the argument. I think the argument only goes 2 inches deep in the argument. It doesn't actually see the whole breadth of the situation.
Yeah, it's kind of like it's just. I don't know. It just almost feels like a catch-22. Do I buy now? Do I buy later? Like, it's just crazy. It's just so much uncertainty out there that I can see why, new home buyers are just on the fence. It's what do I do?
But I think it's because of the uncertainty that you don't know. But if like clients that we have, got them into the house this year. No. They understood what was happening. They understand the long-term commitment, and they have that long-term mentality where they're like, I know that if I hold on, it's going to be even more expensive down the line. And everybody's case is different. But one thing that I did research this week was back when I think Volcker was president.
You're going all the way back?
Damn,
so
check it out.
When he was the Fed chair.
Fed chair. So one of the things that I noticed, and they pulled up a graph, I don't know the exact years, but they were raising rates throughout that period of time. And they raised them up, and then they held them for a few months. They held them for a few months until they started seeing data kind of, unfold and whatnot. But then what happened was that the labor market started coming down. So then what did that signal the Fed to do? Okay, it's time to start cutting. As soon as they started cutting, it started going right back up, and unemployment, same thing followed. Yeah. So I similarly, and they put a graph of years past that they've been doing this, and same thing is happening right now, where they have to hold where they're at if they want to see the results that we're looking for. And the more that we hold, the more pain there is, but in the long term, as a whole, we're looking for that solution. Exactly. And if we go right back to the easy solution, easy way out, our problem's just going to be even worse than what we're just experiencing right now.
Problems.
Yeah, It's just crazy. One of the things that I found interesting to kind of piggyback off of that, the affordability. 39 years.
39-year low. Yeah.
39. Like,
Will, what was 39 years ago?
Wait. I already know you weren't even born.
I wasn't. That's why.
But I do know, just because Michael Jordan is one of my favorite athletes, I'm sure it's one of your favorite athletes. He was drafted. That was the year he was drafted, which is 1984.
Hey, I think income's still the same.
But wait a minute. I was 12 years old. I was 12, you know what I mean? And I had one of those haircuts that my mom used to put a bowl on my head and just kind of cut it like this. I was a little long.
Wow.
They used to confuse me with my sister if we were twins.
Hey.
Put it that way.
Gross.
Ew.
Yeah. Hey, I'll give it that way. I was actually the cuter side of it,
Oh, my God.
All right, anyways, next topic, please.
But, 84,
I was 5.
Jesus.
Yeah.
I was
That's when breakdancing was on, we were wearing the freaking bandanas, the Cavaricis and stuff. It's crazy to even think about that.
I don't know what they're saying, Kaylin. You saying
For everyone watching the show at this part, we're talking about rates and all
they
this.
Just gave
and
up
we're
their
talking
age.
about mortgages. I want you to go back an episode or two, and I want you to start listening and watching the solutions that Will and Brian have brought to the show, where people are actually still getting in real estate right now. They're winning in real estate right now. They're using their equity if they have it. They are doing a cash out in some situations, because even though it may sound crazy on the surface, for some people, the cash out has actually become a net positive for them in their cash flow every single month. Even if it looks ugly on the surface, it's alleviating something pressure point over here. So if you're watching this part right now, like, these guys are crazy. They're nuts. They're just selling for the home team. Go back and listen to the situations we've been talking about, where people are actually saving money, like $1,200, $1,300 a month, because they're clearing other debts in their life. So, sorry, not sorry.
Yeah, listen, an equity line of credit and stuff like that is going to be bad if you're going to go buy groceries with it.
No,
then you're doing
no.
it for the wrong reason, right? But if you have something there, just, hey, I have this equity that's in my home right now that I can count on. How do I just put that there and not incur any monthly payments? Like, there is such a thing of a home equity line of credit that works like a credit card. That money is there in case you need to use it for an investment, to get out of a bind, so that you don't lose your home, and that it gives you that extra cushion for you to survive rainy days,
And what I will say, to follow up on that is, before you look into taking a loan, digging into your 401k, digging into your, IRA or whatever, make sure you run the numbers on your equity. Why? Because you're going to come to find that you're going to save a lot more money, like William was saying, because once you start digging into the other accounts, you pay for pre-tax for taking it out early. You start paying for all these other fees that you didn't have to, because of the fact that money's supposed to stay away. But your house, you've been paying it every month. You've been living in it for a couple of years now. And then thank you to you and your family that made that sacrifice. Now you have an asset that's willing to work for you if you needed to, and you don't have to go dig into the things that are meant for a later time in life. So my advice is, look into your equity before you look into anywhere else for help.
And remember, a loan is not considered income. There's a misconception of people that think, a loan, so do I have to report that in my income?
Of course not.
It's a loan.
Nope. Yeah, it's not reportable income.
It's a loan.
It's not earned income. So
Nope.
great
No points.
Great job, guys.